In this video, I'm going to discuss a brief history of accounting. I'm also going to discuss Luca Pacioli, the father of accounting. I'm going to explain to you what the principle of double entry is. I'm going to look at GAAP, generally accepted accounting practice. Then I'm going to look at the IFRS. Who are the users of financial information and what is the information used for? Then to finish off this video, I'm going to compare management accounts with financial accounts. Well, roll the dice and we're looking at a 5.
Do it, Daddy.
Yes, my boy, let's do it. Let's move on and complete this theory. In 1494, a long time ago, there were a whole lot of merchants sailing around and trading, and all their transactions needed to be recorded. So this famous accounting individual, Luca Pacioli, who was a friar way back then in 1494, a very intelligent individual. He was friends of Da Vinci. So Luca, what he did was he wrote a book, and because of his work that he did on accounting, he got dubbed the father of accounting. And this is a picture of the book he wrote. This was actually a thesis that he did on merchants and how they could record all their transactions. And the name of the book was, you might need to help me here if you're Italian, Summa de Arithmetica, Geometria, Proportioni et Proportionale. Right, you can try and pronounce that. But he wrote this book, and you can see there, this happened in 1494, and it was the Republic of Venice, Italy. So this is how Luca Pacioli became known as, or dubbed, the father of accounting, by writing this book on how to record information. You'll see in a slide I will show you shortly. He recorded the principle of double entry, but more about that in a moment. So what you need to know is the father of accounting, he wrote a book. His name was Luca Pacioli. He was a friar from Italy way back in 1494. Luca very carefully or cleverly introduced in his book the principle of double entry. So if we look at this capital account, the principle of double entry says for every debit there is a credit. This is a capital account from a general ledger, which I do discuss in my other videos. So this was recorded in Luca's book. It was already happening, the principle of double entry, but he cleverly recorded this principle for the first time. Also at that time period, Arabic numerals were being used, as opposed to Roman numerals, because with the Arabic numerals it was much easier to record transactions. You could record bigger numbers. So Arabic numerals came into being in bookkeeping. And also at that time, people owned property and assets, and that information needed to be recorded. It was important to record who owned what. So all this was taking place way back in the 1400s, early 1500s. So accounting goes back a long way. Luca documented, this is amazing, way back then, that merchants needed either cash. Obviously you need cash to buy your stock if you want to trade and sell, or access to credit. So already back then that was identified. You either need cash or credit in order to buy stock. These days you can take a loan from a bank if you don't have cash, if the bank grants you a loan. All transactions needed to be kept record of, so bookkeeping was already, you need a good bookkeeping system. That was also identified by Luca, and it was and still is for some places. Manual bookkeeping takes place, but we all know that accounting software is used by most places and is readily available, and there you end up with journals and ledgers. But it is important to understand what actually happens in accounting, so you know what's going on and what is the software doing. That's why we're doing, or you do, a course on accounting, in order for you to understand accounting so much better. Why is an account debited? Why is an account credited? So way back in time, cash was identified as necessary, or credit. It's the same today. A decent place to record the books or method of recording the transactions was needed, a bookkeeping method, and we know manual bookkeeping, and you can purchase accounting software to do that recording for you. As time went by, generally accepted accounting practice came into being. Now GAAP, generally accepted accounting practice, GAAP is a recognized set of rules that apply to financial information. And these rules result in honest financial reporting. So it's important to have rules to standardize how things are recorded or how transactions are recorded. So it's important to put some rules in place. So GAAP is a recognized set of accounting rules. I just thought I'd throw this in here. Accounting concepts are assumptions and ideas, and these concepts form the foundation of the accounting process. So concepts are ideas and assumptions, while on the other hand, accounting principles are the rules and guidelines for applying concepts. So there's the difference between concepts and principles. Concepts are ideas and assumptions. whereas principles are rules which guide the application of accounting concept. So back to GAAP. GAAP is a set of rules which promote honest and consistent accounting practice. So South African GAAP has since been replaced by the International Financial Reporting Standards. And the benefit of that, like I said in the previous slide, it enables comparability and understandability of financial reports across countries, across the world, because the books are being kept the same way. They're following the same international rules and principles, the same international framework. So the IFRS, the International Financial Reporting Standards, provide a worldwide business language that enables the books across countries to be compared, understood, and reported on in an international way, the same way. I thought I would include these qualitative characteristics. The IFRS, International Financial Reporting Standards, try to control the quality of financial records by putting in place fundamental qualitative characteristics, and 2, enhancing qualitative characteristics. So the IFRS is trying to maintain standards and quality control of financial information. So the fundamental qualitative characteristics are relevance and faithful representation. So all information that is relevant for stakeholders to make decisions, any information that influences the decision making of stakeholders needs to be included. For example, an item of value. That is the materiality principle. It is relevant if an item is of significant value and it influences the decisions of stakeholders. All information must be honest and accurate, so there's faithful representation. Then there are also enhancing qualitative characteristics, comparability, understandability, timeliness, and verifiability. Now, comparability means the financial records you must be able to compare last year's records with this year's records. So reporting needs to be consistent. Then also you need to be able to compare your books with other businesses in your industry. So policies need to be reported on, and policy needs to be consistent. All the information needs to be understandable to stakeholders, with those people that have a bit of knowledge, economic and accounting knowledge. The information needs to be clear and understood. The timeliness of the information is very important. So if decisions need to be made, information that helps those decisions being made need to be in the correct period, so in the correct financial year. transactions need to be recorded at the right time. And the last enhancing qualitative characteristic I'm going to cover in this video is that of verifiability. Now what that means is, if another auditor goes and does the books, they should come to the same results as the initial auditor. So the second auditor will verify what the first auditor recorded, or the results and position that the first auditor reached. Those results and position of the business should be verified by another auditor. So the books were recorded in such a way that the same results and positions can be verified by another auditor. So there we go. The IFRS has put some qualitative characteristics in place, fundamental qualitative characteristics and enhancing qualitative characteristics. This could be a short question, so know it. It's important, but the IFRS is trying to just keep control of the quality of the financial information that is being reported. And just to recap on the qualitative characteristics, all these numbers here in Qualitative Education, they should be relevant, honestly and accurately recorded. Same policies should have been used in able to compare previous years with the current year and with industry norms. All this information should be clear and easily understood. All the information in the books here, in this trial balance, should be in the right, correct period. And if someone else went and did the books, they should get the same results as the first person who did the books. So there we go. There are lots of users of financial information. Here we have Qualitative Education, and users that are interested in Qualitative Education's financials, the financial position of Qualitative Education, are lenders, the bank, suppliers, and customers. So we're looking at users of financial information. Now I've identified some users of financial information of Qualitative Education. Investors are interested in the financial results of a company to make decisions whether to invest in Qualitative Education or not. Existing shareholders of a public company would be interested in the results of the company, as it would change their minds on whether they want to invest, whether they want to buy shares or sell shares. It depends how the company is doing. And then also investors are interested in seeing whether the company they've invested in has made a profit or not, because if they've made a profit, the company will be able to pay a dividend. Remember, shareholders invest in a company because they want a share of the profits, a dividend. So investors are extremely interested in the financials of the businesses that they invest in. Lenders, like the bank, are quite concerned whether the business that they've lent money to will be able to repay their debt. Will they be able to pay their monthly installments on the loan that they've received from the lender? Suppliers are also interested in the business, obviously to see if an account can be settled. So if we buy from the computer store on credit, the computer store is concerned as to whether we can pay our account or not. So they're interested in how the business is doing, how Calibre Education is doing. Customers, the school is a customer of Calibre Education. They are concerned with the business in terms of continuity, because if Calibre Education closed down, where would they get their educational material from? So customers are quite interested or concerned with how the business is doing. So there you go. There's 4 parties that are quite interested in the financial information of, in this case here, Calibre Education. Let's see on the next slide who else is a user of financial information. Employees and labor unions are interested in the results of the business, the results of the employer, as they want to determine whether they are being fairly paid, fairly remunerated, and also is the business in a good position, and when these employees retire, will the business be able to pay the benefits that were promised in their contracts? And also labor unions, they're obviously interested in how the business is doing, so they can determine whether employees are being exploited or treated fairly. So employees and labor unions are quite concerned and interested in the financial information of the business. Users of financial information, there are even more. Governments are interested in the financials of business in order to regulate business and to determine tax policies. The public are interested in the statements of enterprises to see how the businesses are doing that they're involved in, and if they're still going to be around in the future. And maybe just if you're a businessman, you're interested in other businesses and how they are performing, whether they're profitable or not. Management, they need the financials in order to plan, lead, and make decisions about the future of the business. So the financial results are very important to management to lead the company. So to summarize, these are the users of financial information, the most common users of financial information: investors, employees and labor unions, lenders, suppliers, customers, government, the public, and management. These users of financial information are interested in the financials, how the businesses have done that they're involved in, whether they made a profit or a loss, and the financial position that they're in. So quite a few parties are interested in the financials of business. And here I've listed all those that are common and are interested in how your business or businesses have performed during their financial year. The users, the investors, the lenders, the suppliers, the governments. Now the users have the following uses of financial information. So now we're looking at the uses of financial information. Don't get confused between users and uses. So these are the uses of financial information. What we can do with the financial information is we can determine the position of the business at the end of the financial year. And the position of the business is shown on a statement of financial position. As we get further into accounting, we will look at these statements. But one use of financial information is to determine the financial position of the business. We can also determine the financial result of the business, whether the business has made a profit or a loss. And this information is recorded on a statement of profit or loss and other comprehensive income. So this is an income statement which lists the income and the expenses. So a use of financial information, another one, is to determine whether a profit or a loss has been achieved. Management can analyze the costs of the business and therefore make informed plans. So management can see a whole lot of things from financial information and plan the way forward. And they can determine whether the policies in place are the best for the business. Certain accounting policies, are they using the correct policies? Is the business using the correct policies? Should work be outsourced, or should we do work ourselves? For example, the marketing of a business, would it be more cost effective to get someone else to market your product? You can determine which activities are profitable. Say for example, Calibre Education, which videos are more profitable than others, which videos are highly sought of or sought after. So you can see there are many uses of financial information. You can determine the position, profit or loss, cost of the business. By using the information, you can plan ahead. Are the policies the best for the business? Should work be outsourced? You can identify which activities are profitable. So financial information has plenty of use to the users. These are just some of the uses of financial information. To finish off this video on accounting theory, I'm going to compare management accounting with financial accounting. What are the differences between the two? So management accounting, they provide information to internal stakeholders, for planning, controlling, motivating and evaluating performance. So management accounts takes the information and they go to the different departments within the company and they can discuss what has happened in these individual departments. So the information is for internal stakeholders, employees, management within a company. So management accounting is going to use financial information to, let's say, motivate individuals within a company. Now, on the other hand, financial accounting provides information to external users. For example, the revenue services, lenders, shareholders. So information, financial information, management accounts provides the information internally, financial accounts externally. Now, with this financial information, management accounting can plan ahead. So they will take the information and analyze the information and take corrective steps if necessary. That's the responsibility of management accounting, and plan the way forward. Financial accounting summarizes and records the transactions that have occurred to date. And they do this accurately so management can use that information that has been summarized. The data information must obviously be relevant to make informed decisions for management. So if you're going to make a decision on a specific event or something that has happened, all the information must be relevant to that event you're going to make a decision on. Financial accounting, the data must be factual and verifiable. So exactly what happened gets recorded, the facts. Verifiable means if someone else had to do the books, you would get to the same result, the same profit. It can be verified by another accountant. So data in financial accounting is factual. Timeliness of information is required. So if you want to make a decision, the timing of the information, the relevant information is required in management accounting. If a decision needs to be made, all information required for that decision to be made properly needs to get to you on time or get to management on time. So information needs to be on time to make informed decisions and plans. Once again, financial accounting, all the information needs to be accurate. Reports are written for the different business divisions, customers, products, and employees. So management takes the financial information and reports on that information. Financial accounting, the information is summarized accurately, factually for the entire business, and it's passed over to management, who analyze and interpret that information. There's no need to follow GAAP, generally accepted accounting practice, and international guidelines, accounting framework. There's no need to follow the rules and principles. but financial accounting, they need to follow the framework that is put in place by the IFRS and GAAP. Reporting in management is voluntary and can be done by means of reports, emails, letters, memorandums. And in financial accounting, statements are compulsory. A statement of financial position, a balance sheet, a statement of income and expenditure, an income statement, they are compulsory. Remember, management analyze and interpret the reports. They manage and interpret, analyze and interpret the statements and the numbers produced by financial accounting, and they plan the way forward. So there we go. There's management accounting versus financial accounting. Maybe it's a short question. Compare the two, and now you know the answers. I hope you enjoyed that little bit of theory. Now that you're wiser in theory, keep going, cause a ripple in the water, cause a ripple effect. And I hope you enjoyed that lesson. The crab is still on my head. It has removed my glasses already, and now I don't know what the crab is doing. Keep going, everyone. I hope you enjoyed this little video on the theory of accounting. See you soon.